Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
You got 401ks, IRAs, Roth IRAs, Social Security, Medicare, Medi-Cal, longevity, interest rate. What does all of this mean? It's overwhelming for a lot of people to even plan for their retirement, so they ignore it. But not today, folks. Big Al and I are going to give you the tools to create your retirement income in success. How about that? Welcome to the show. Joe Anderson here, certified financial planner with Pure Financial Advisors. I'm with the big man, Big Al Clopine. He's sitting right over there. We're going to get to Big Al in a second. But when you take a look at financial planning or your overall retirement plan, you would never dream of building a house without a blueprint, right? Why are so many people going into retirement without that blueprint? That's what we're going to discuss today. That's the financial focus. Alan, when you look at creating a retirement plan, it's very difficult for people to plan out exactly what they need to do without this blueprint, because people will buy stocks, bonds, mutual funds, and they ignore taxes or longevity or what that portfolio should look like. Are you in debt? Not in debt? You have to figure things out when you create your overall retirement blueprint. That's what I want to get in today, and that's why I want to bring in the big man, Big Al Clopine. Alan, I think a lot of times when people look at retirement, they might think of a number or a date or an age, instead of putting together a game plan way ahead of time to make sure that they can do all the steps to make sure that they have that successful retirement.
Well, you're right, Joe, and there's a little bit more to it than just a number.
Right, exactly.
It's really a matter of understanding what tools are needed to create a great retirement. So on today's show, we're going to give those tools to you, and we're going to start out with number one, getting out of debt. So that's number one. If you're in debt, there's some strategies that you want to get out of debt as quickly as possible. Then how much to save, that's really important. Now that does get to your number, how much to save, what do you need? How to invest for success. So you've saved this money, but you want to be able to retire, you want to create a cash flow, how do you do that? And don't forget income taxes. Income taxes will often take more from your portfolio than the stock market will. And then how about putting it all together in terms of designing and creating a great retirement plan? And Joe, this really, it's all about the tools, it's all about what's available. So few people do this because it is overwhelming, but if you take a few simple steps, you can be assured for a much better retirement.
Right, I mean, I think a lot of times people just ignore this. It's like, all right, well, hope is not a strategy, folks. And it's funny because Big Al, it's baseball season, he went to Petco Park, and he interviewed a bunch of people and said, you know, well, what's your readiness for retirement? What inning are you in? Let's take a look.
Hi, I'm Al Clopine. I'm here at Petco Park, and I want to ask you Padres fans, are you ready for retirement? We're going to find out right now. What inning would you say you are in your career?
Middle of the sixth.
Bottom of the ninth.
I'm in the seventh.
Seventh inning, very good. Seventh inning stretch?
Yeah.
I'm still in the batter's box.
You're in the batter's box, okay. What inning would you say you're in as far as your career? So what do you attribute your success to?
This one right here.
Yeah.
Good answer.
What do you attribute your success to getting ready for retirement?
Well, I'm an accountant, so it's part of the nature of the business.
We have an accountant here. We have an accountant. Do you feel like you're on track for retirement?
Oh yeah, right on track.
And you aren't thinking about retirement at all, are you?
Nope.
Good, you shouldn't be.
No.
No? What do you think?
No.
That's a great hat, Al.
It's a
great hat.
It's a little small.
It's a great hat.
Now that I see it on TV, it's about 2 sizes too small.
Oh boy, it looks good with that suit. Looking sharp.
Yes.
Yes. Let's get into the tools. Let's help you viewers right now today that didn't make it to Petco Park to see Big Al to get the tools ready to make sure that you have a successful retirement. Number one, when you go into retirement, you got to assess your debt. You got to take a look at, all right, you probably want to stop borrowing money at this point. And then create a realistic budget, bud.
Yeah, you do, and then you want to map out your debt repayments. You want to make a list of what debts you have and figure out what order you want to pay it. There's a couple ways to do it. One is pay your highest interest rate card first, and that can work. In other cases, people like to pay the lowest debt first just to create some momentum. And then finally, stick to that plan. And so So first of all, decide not to borrow anymore and then get on a plan to repay it. So that is actually step number one, and tool number one to retiring.
Yeah, because if you had a lot of debt, a lot of consumer debt, maybe having a mortgage might be all right. But if you have a lot of consumer debt, credit card debt, car loans, and things like that while you're approaching retirement, you're going to have a lot more money to be saved to make sure that you pay off your debts and still provide your lifestyle. Most people have no idea how much money that they should have saved. So let's take a look here. How much money should you have saved depending on your age? So take a look. If you're 35 years old, you should have 1 times your annual salary saved by now. So if you're making $60,000, you should have $60,000 in the bank. Once you hit 40, it's 2 times. So if you're making now $100,000 at age 40, let's say, you want to make sure that you have about $200,000 saved. Once you hit age 67, that close retirement age, you want about 8 to 10 times your annual salary. 8 to 10 times, Al. That's a pretty big number. I would say most people don't have anywhere near that.
It is a big number. And of course, we got to say that these are only guidelines because it's going to be different for everybody, because the sooner you retire, probably the higher multiple that you need. If you retire later, you don't really need as much. And then it's all about your longevity and your spending and all kinds of things. But this will at least give you a guideline. And I think probably a lot of you realize that, well, yeah, we kind of are a little bit behind. And so that's why we do this show. We want to give you the tools to get back on track. So take a look at what you've saved, take a look at your age, take a look at your salary. Are you on track or not? I'd be willing to bet many of you are a little bit behind. So now it's time to get serious about retirement planning.
Right, and it's never too late to start. I think a lot of times people will hit in their 50s and 60s and they don't have a lot of money saved, and then they feel this hopelessness. Well, I'm never going to be able to save. No, you just start slow and then you increase that dollar figure each year. So once you hit in your 60s, just know a good rule of thumb to see if you're on track is about 8 to 10 times. So if you're making $100,000 at 67, you want about $800,000 saved. So again, that's a rule of thumb. A lot of you might want to tone down your lifestyle. You might want to downsize your home. There's a lot of different things that you can do and tweak these numbers a little bit to make sure that you can do what you want to do. Al and I have been doing this for many, many years, and there are some individuals that have millions of dollars saved and they will burn out of their money very, very quickly. Other people have maybe a couple $100,000 saved and they are happy as all get out. They're having the most fun and a very, very successful retirement because they know how to budget, they know how to live within their means. Money isn't everything, but it helps, I guess.
It does help, and I think that's very true, Joe. So there's income and there's spending, and if you could have and investments, your investments can be way up here, but if your spending is even higher, it just doesn't work. And we've seen both cases, as you mentioned, people that have a lot of money that are going to run out of money, and people with not very much. They live within their means and they're very successful in retirement.
Hey, we're just getting started. Don't go anywhere. When we get back from the break, we're going to dive into all sorts of different things that you need to know to make sure that you have a successful retirement. We'll take a look at the stock market, what asset classes outperform others, how is a diversified portfolio actually constructed, and much, much more. So don't go anywhere. Good morning, everyone. Show's called Your Money, Your Wealth. We'll be back in just a second. Hey, welcome back to Your Money, Your Wealth, giving you the best money information on TV at this time. I'm guaranteeing you that. We got a great show. We're talking about building tools for your overall retirement. A lot of you go into retirement and not necessarily understanding what tools that you should have. So that's what we're getting into today. We got a great segment, so don't go anywhere. Before we get in, let's go to the true-false question.
If I'm in poor health, I should claim Social Security as early as possible. True or false? Boy, I would say it depends, Joe. I think it depends whether you're married or single. Let's say you're married and you're the higher wage earner and your spouse is in relatively good health and your benefit's going to be a lot higher. You might want to wait on your Social Security because he or she will get the survivor benefit, which will be higher. If you're single, certainly yes, I would say claim it as soon as possible.
Yeah, and that number is age 62, so you can claim it as early as age 62. So if you're not working, if you're in poor health, take it at 62. You do receive a 25% permanent haircut on that benefit. But if you don't believe that you're going to live in, let's say, until age 70, well, yeah, if you need it, if you're in bad health, take it as soon as you can get it. Alan, I think it's time.
Well, it is
it's
time,
your favorite
Joe.
segment of the whole morning.
It is, because you get put on the spot and a client asks you a question and you have no idea what the question is. So let's see how you do.
Hi, Joe and Al. I'm Shirley, and I want to know, what is my number? How do I know when I can retire?
What's the number? That's a very popular question, so it really depends on a lot of different factors. Let's kind of break it down. Here's what you want to first look at. There's some rules of thumb that actually work pretty good here to find your number. Is that there's a sustainable distribution rate. You don't want to pull out any more than 4% out of your overall portfolio. So if you have $100,000 saved, you don't want to pull out any more than $4,000 per year, of course, if it's globally diversified. So you're trying to figure out what your number is. You have to first figure out, okay, well, how much money are you spending? What is your fixed income sources, such as Social Security, maybe a pension, maybe a real estate income, right? So you take a look at what you're spending minus what your fixed income sources are. You're going to find your shortfall. So let's say you want to spend $100,000, Shirley. You have $50,000 of Social Security and fixed income. You subtract that, and then you have $50,000 as your shortfall. You multiply that by 25 or divide it by that 4%. That will give you your number. Boom. Yes, I did. I got that.
Wow, right on the buzzer. That's pretty good, Joe. And I think you explained that really well. And in this show, we're talking about the tools for to develop your own retirement plan. We talked about getting out of debt. We talked about how much to save, what's your number. But once you have saved, it's how do you invest? And that's a real important topic. So we're going to spend a little bit of time on this because there's a lot of confusion on how you should construct a portfolio. So I think the first thing we want to talk about is different asset classes have different expected rates of return. Now, this is a 20-year annualized returns from 1995 to 2004. This is from Dalbar, a company back east. And they said the last 20 years, the S&P 500 has earned about 10% per year. Now, if you look at bonds and gold, it's about 6% and so forth. Homes, about 4%. But look at that second to last box, average investor. The average investor over that period of time has only earned 2.5%. Joe, how could that be? If the market's returning 10%, but the average investor is earning 2.5%, what are we doing wrong?
Yeah, it's the behavior, right? You know, that's a funny chart because it had oil on there. And that was at 2014. If you take a look at now, 2015, that's a little bit different story.
Yeah.
But it's behavior, right? So the average investor does something extremely lower than what the overall market does is because we're buying and selling at the wrong time. Because we get excited when markets go up, we buy in. But when markets go down, guess what? There we get that fear. We get a little fearful, and so we sell out. So we do not achieve the full return of the market most of the time because of our behavior. Dalbar does a study each and every year, and guess what? It's the same story each year. Individual investors have such a behavioral problem when it comes to their money that they can't stand it when the markets get a little bit jittery. So what do? They sell out, they wait till it recovers, and then they buy back in. They're buying and selling at the wrong time, and they do it most of the time, all the time. Let's look at another statistic when it takes a look at, all right, well, growth of $1. What type of asset classes should you own here, Al? Because certain asset classes, have different expected returns.
Right, and here we're looking at 1926 through 2015, and you can see the highest performing asset class on this chart was U.S. small cap, so small companies. $1 from that 1926 would be $18,000 now. Large cap index would be like the S&P 500. That's about $5,000. What about a T-bill? Nice, safe T-bill. You're only at $21. And so the point here is different asset classes have different expected returns. And it really has a lot to do with risk. When you think about it, the higher risky assets tend to earn more over the long term, but it's a more volatile ride.
Right. You want to take a look at, all right, well, each investment has risk, right? And so the smaller companies have the most extreme risk. That's why you see it has the highest expected return. T-bills are one of the safest investments on the planet. That's why you do not see a huge return here. So when people want to approach approach retirement and say, I don't want to take on any risk, well, just realize that you are giving up return. And if you look at, all right, well, I'm retiring at 65, you still have 35 years of life, potentially, or 30 years of your overall retirement. So it's not like going into T-bills. Your money will never double. You will more likely run out of money because you might not have had enough saved to begin with. So a globally diversified portfolio is the best way to go, to have a little bit of each of those different categories. Now we take a look at, all right, well, timing markets. Going back here again, Al, if you're fully invested from 1995 to 2014, right, $10,000, you got about $70,000.
Yeah, in other words, if you stay invested, if you have a globally diversified portfolio. Now, if you miss the 10 best days in the market, look at that, your return is cut in half. You're about $35,000 instead of almost $70,000. And you can see 20 days, 30 days, 60 days. Most of the return over a 20-year period was during those 60 best days. And then the thing that you might think of is well, I don't have to stay in the market at all times because I can figure out what days to invest. The truth is nobody, Joe, knows when to invest.
It's so random, and it hits in spurts. I mean, that's a 20-year time frame. If you miss just a couple of days, because you see the markets when they zoom up in one day, it's like, oh, I missed it. Damn it. Now what do I do? Then you go in the next day, and then it's down, and you're like, shoot, now what do I do now?
Right.
So it's just getting the right investment story down, given what your goals and dreams are.
Yeah, so let's kind of summarize. So I think the first thing you want to do is to diversify globally. So you want to have some U.S. company stocks, you want to have some international, maybe some emerging markets. You want to have bonds, some safety in your portfolio, different classes of stocks. In every single case, you're going to have certain asset classes that outperform other classes, so you're going to need to rebalance over time as your portfolio gets out of balance. You want to look at low-cost funds like ETFs or index-type funds, and most importantly is you want to stay invested, and this is probably the biggest mistake people make, and this is why the market, as we showed on another slide, earned 10% over a 20-year period, and the average investor was 2.5%, is getting in and out of the market. Once you get the right plan, you want to stay invested.
Yeah, and then you have to, of course, take a look at taxes. Taxes is, in most cases, going to be one of your largest expenses. So you have to look at, all right, well, what type of funds do I own? Do I have retail mutual funds? That might have a lot of turnover. Well, you want to keep those type of funds inside your retirement account so they grow tax deferred. Index funds are a lot more tax efficient. So those are assets that you want to hold outside of your retirement account. Corporate bonds versus municipal bonds. Muni bonds, of course, will give you tax-free income. Corporate bonds will give you taxable income. IRA distributions versus Roth. Roth IRAs, in our opinion, is the best gift the IRS has ever given us because every dollar that goes into a Roth IRA will grow 100% tax-free. Every dollar in your IRA is going to grow 100% tax deferred, but when you pull those dollars out, guess what? You're going to get killed in taxes in most cases. Then you have to take a look at another sophisticated study. That's why I got Big Al right next to me, CPA masterman, when it gets into tax loss harvesting. Explain that in 5 seconds, bud.
Yeah, that's hard, but here's an example of what's happened in the market, and our graph is a little bit off because this really should have been 2008, 2009, where the market dipped so much.
Well, this is great, right? 2008, that's Big Al.
Those are my investments.
Yeah, that's your investments.
I tanked in 2011. But here's the point. The point is when you have an asset class that goes down, you actually want to sell it to create a tax loss. If it's outside of your retirement account, if it's inside your retirement account, this doesn't work. So these are non-qualified accounts. But your asset class goes down, you sell it, you create a tax loss. You can use that tax loss against any other capital gain. And then most importantly is you invest in something similar so you're still in the market, but you got a loss that you'll be able to put on your tax return. You get to take $3,000 a year against ordinary income, and you get to take the entire thing if you have enough capital gains to offset against it.
All right, we got to take a break. When we get back, we're going to wrap this show up, and then we're going to flip it to you to answer your email questions. So don't go anywhere. The show's called Your Money, and it's Your Wealth. Hey, welcome back to the show. The show's called Your Money or Wealth. Joe Anderson and Big Al Clopine hanging out, talking about putting together an overall retirement strategy, helping you build the blueprint that you need in the tools that you need to have a successful retirement. Stick around. We're going to turn the show to you and answer your email questions in just a second, but let's go to the true-false question.
Annuities are a good way to provide a constant stream of income during retirement and protect my money from market fluctuations. What do you think, Joe?
Yeah, I suppose. I mean, I'm not a huge fan of annuities. Annuity means income. And if you look at a tax-deferred annuity, immediate annuity, there's variable annuities, there's indexed annuities, there's all sorts of different types and flavors of annuities. If an annuity will give you a guaranteed income stream for the rest of your life. So that's the pro. The con is that in most cases, if you do the math, your internal rate of return is very, very low, right? The insurance companies are in business to understand math and actuarial tables. So they get how this all works. So sometimes how it's sold, it sounds like a really good deal, but basically what they're doing is they're slowly giving you your money back over a long period of time with a little bit of interest. So you just want to do your due diligence if you ever decide to get into an annuity. But yes, it would give you a guaranteed income, so that's the pro. The con is that there's a lot of different flavors in there, and most of those flavors are pretty rotten, in my opinion.
All right, so you're going with false, it sounds like.
I didn't say that, Alan. I just said you just got to be careful.
Got to be careful.
Got to be careful.
I will agree with that. And Joe, I think we've talked about a lot of the tools that you need. You got to reduce your debt. First of all, you got to figure out how much to save and how to invest, and you got to look at taxes. And now it's about creating a financial plan. What should go in a financial plan? Well, first off and foremost is a savings and debt reduction plan, certainly. And then you got to consider what kind of lifestyle do I want to lead in retirement? Is it the same as what I'm living now, or maybe I want to up it a little bit to travel, or maybe I want to downsize, whatever. You've got to take a look at your fixed income sources, because in most cases your lifestyle will be greater than your fixed income sources, Social Security and pension. So then you got to have an income plan for the shortfall, and that's from your savings. And then finally, a game plan for how you will spend your time, because Joe, in a lot of cases people spend so much time figuring out their number and how to live their retirement financially, but there's more to it than that. You got to have a plan on what to do each and every day so that you stay motivated and happy.
Yeah, you got to find your purpose too, right?
Yeah, you do.
There's a lot more individuals that now are retiring, that are going back to work, that are doing something that they love, maybe volunteering, staying busy, staying active, because retiring at 60 and then dying in 15 years is not the case today, right? I mean, more and more people should be working till at least age 70, in my opinion. 70 is the new 50. We're going to live a lot longer. The advancements of healthcare and everything else. So a lot of individuals are going back to work, just because, not necessarily because they have to, because they want to. So it's not like just trying to find this number and then punching. Just have a game plan in place to make sure you truly find what you're trying to accomplish. All right, let's go to the email questions. We got time for a few. Let's do it, Al.
All right, number one from Lori, Mission Valley. I am divorced. I have only one child. Do I need a family trust for my son to inherit my home and my assets if he is already the named beneficiary for all of my money and property? And Lori, that's a great question. Do you need a trust? Or if you have a will a will work? A will work. In other words, the house will go to your son through a will. A lot of people, though, get a trust because when you have a will, you got to go through probate, and there's court costs, there's attorney's costs, and it takes a bit of time. A trust, the assets can be transferred very quickly and easily without any public record. So a lot of people go the trust route to avoid probate, but you don't have to. As long as you have a will, that will work.
Yeah, I think there's confusion there, too, with the terminology, Al. It's like, well, here, all my property has a named beneficiary. Well, your primary residence does not have a named beneficiary, right? That's an IRA, a retirement account. Your life insurance has named beneficiary. A property is a hard asset. It has to change title, right? So it has to figure out how to do that. You either do it through a living trust, or the courts will do it through you through a living will. So let's go to the next email question.
All right, I think this is Jason in Costa Mesa. He says, I'm 56. I left my full-time job last year. This year, I plan to work part-time as a sole proprietor consultant. If I make $24,000 in earned income in 2016, can I shelter the entire $24,000 into a solo 401k and pay no tax? And Jason, that's a great question and very astute. There is a plan called a solo 401k. You can have your own 401k as a small business owner, and if you're over 50, you can put in $24,000. So that is true, but you probably don't want to put in that much, because if you think about it, if you're a single taxpayer, for example, you get a standard deduction, you get an exemption, you add those up together, that's about $10,000. So you will have $10,000 of deductions just for nothing. So you probably want to put about $14,000 into that solo K, and maybe you put $10,000 into the Roth side of the 401k. Have a solo K that has a Roth component, and that's a really good way to do it. You still will pay self-employment tax, though. You can't get around that.
Yeah, but then you have to take, I mean, that's kind of looking at it inside of a box, too, Al. We're assuming that there's no other income in
True.
how is he going to live and everything else. So let's say you had other income, you got the $24,000 and you don't want to pay tax on that $24,000. Yeah, go ahead and shelter the whole thing. You do pay self-employment on that 24, so you can't probably get the full 24 in, but you can get a ton in. Wow, what a heck of a show. I got to tell you, a lot of fun. Hopefully you enjoyed it as much as Al and I did. Join us again next week. We're going to get into more stuff that has to do with your financial life than you could possibly imagine, that we could possibly fit in a half-an-hour show. Have a wonderful weekend, everyone. For Big Al Clopine, I'm Joe Anderson. You just watched another episode of Your Money, and it's Your Wealth.